Christian. Thank you for investing your time in me, sir.
Antonio, it's nice to have you again.
Oh yeah, absolutely. Last time was very educational, so I think this time is going to be education as well, though, because you told me that $4 copper might be the new normal. Some people are saying that copper might be the new oil. All these, interesting things going on. I already took two positions, and I don't feel like I know enough to have taken them, but it was like in the moment. Whatever, I'm still degenerate, but you're gonna tell me more about it. Let's go into the presentation.
Sounds good. So I put this presentation together about a year ago, and I did several retail talks on this topic, plus $4 copper, the new normal. It was very well received, and it is, I think, a good representation of my own portfolio and net worth as well. I think it's also timely because on Twitter, saw a lot of people the last few months with the lockdowns in China suggesting copper was going to drop to $3.50 or $3, and I was adamant that copper was going to stay over $4 a pound. And I think that $4 a pound is actually very cheap for copper where we are in the world today. And I think a lot of people hasn't clicked in the mind that it is cheap, because the reality is, in the history of the world, copper has only been over $4 a pound for a very short period of time. So why did this happen so quickly? And why am I so adamant that we'll stay here at a base of $4? And I think you'll be seeing $10 a pound by the end of this decade.
Is this maybe that, just before you go on, is this, so you're saying that this sort of, $4 is going to be sort of the support. So if I'm doing some type of a risk reward calculation, then my risk would be falling to $4. Is that what you think the bottom?
Yeah. And really, when it comes down to it, does the world need more copper? Yes. We're in a point of disruptive technologies and disruptive industry, which is going to be, how do we tackle climate change? So a massive new use for copper. So we need new copper. What is the incentive price required to build new copper mines? And the incentive price is what is, if you look at the average new copper mine to be developed, a brand new copper mine, what copper price do you put in the model to generate a 15% after-tax rate of return? And that number today is probably in the $4 to $4.25 per pound copper. And so you need new copper. Okay, you need to build new copper mines. So what's that floor? $4 to $4.25. So actually, in the last few months, at the beginning of this year, we've been in a backdrop where the copper price has not been high enough to incentivize new copper mines. So that is really the whole thesis of this presentation I'm going to give. And I'm going to talk about how the incentive price has moved over the last 20 years and why it's at north of $4 a pound, where at the beginning of this century, it was much, much lower.
Okay.
So obviously, I believe what I'm saying because I'm all in copper. I'm the founder and CEO of Aventus Mining. So we're building the next copper mine in the world, which happens to be the most economic copper development project in the world, really driven by grade. So we've got 10 million tons at 5.5% copper equivalent. We're going to be breaking ground shortly, and we just got our environmental impact assessment permit last week. So this is all about cash flow story in copper, what's the next mine to be built. And then I'm also the chairman of a company called Surge Copper, and I led the reboot of this company a few years ago. We're in British Columbia, a big copper district with a mill in the middle of it, currently on care and maintenance. This is all about size and a strategic district and big pounds in the ground and of interest to the majors such as BHP, Rio, etc. So I've got my cash flow story covered, and I've got my big pounds in the ground, big strategic value. And these two companies make up the majority of my net worth.
Fair enough. And also, fair disclaimer and honest confession for everybody watching. Surge Copper is also one of the two copper stories that I've picked up, just so they know if I ever referred to it or if you ever referred to any of those two, that obviously we should be considered biased. I think that's fair to say. From there on, you wanted to, I guess, okay, so you were going to be talking about the demand side of the story. Let's go.
Yeah, so I talked about this disruptive phase that we're in globally. So This is a very interesting time for metals in general, but I would say in particular for copper, you have a deleveraging that has occurred around the world in all industries with the significant rate hikes taking place. And that has driven in particular venture stocks to ridiculous levels. But at the same time, you have very strong fundamentals for metals, in particular copper, driven to what I'm going to talk about in this slide, and very low inventory levels. So this is nothing like the global financial crisis, for example, in 2009, 2010, even though some stocks seem like they're trading at those levels. This climate change movement is all about going from fossil fuels and replacing it with metals, in particular copper, although it also is going to touch things like lithium, cobalt, nickel, etc. But in terms of the size of those metal businesses that are going to win out of climate change, copper is many, 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 many times larger. And that's why I suggest investors look at copper, because it's a transparent business, it's large, it's material enough for companies like, any of the major companies to really grow. And so companies like Teck, BHP, Rio, their focus right now on all metals is growth in copper, and it is sizable enough for them to grow in those sectors. So if we look at what is the impact, so on average, a gasoline car uses 15 kilograms of copper. An average electric vehicle uses 60 kilograms of copper. Similarly, if we look at call it a natural gas power plant or a coal-fired power plant, you're going from 1.3 tons per megawatt of copper to 6.8 for the more renewable types like the solars and the winds. And so all of this, if you just look at the electric vehicle segment and all aspects of electricity distribution, as well as the production of the new cars, it's going to boost the copper demand by 14 times over this decade period. So to me, I don't really care about if there's small copper surpluses that occurred last year or may occur this year. This is all about the future and how we can create a path to delivering the metal that we need to achieve the climate change goals that we're talking about.
Okay, so now we're going to talk about the supply. That's what I was going to ask about the supply. And also because you say you don't care about the surplus, but what about above ground inventories? Are those known? Do you have an idea of how much inventory we might have?
Yeah, we're at a point of less than 10 days of inventories for copper globally. We are at record low inventories. It was even lower earlier in the year, but I don't care about current surpluses, although minor. And from an inventory perspective, there's not a lot. So there's very little elasticity in the market. We're literally one pit failure away in one of these major copper mines from being in a critical scenario. If Escondida, for example, had a pit failure and had to be shut down for a year to get back on track, we would be in a very precarious situation. So inventory levels are extremely low.
Okay, and also, by the way, that may be a point, because most of the world's supply comes from countries like South American countries, Chile and Peru, right? If I'm not mistaken, and they have let's call it challenging political situations at the moment, and they also have people protesting against copper mines. They're blocking copper mines because sometimes they take away jobs or whatever from farmers, but also they're just copper is oftentimes, from what I found, mined open pit. So basically those are huge holes in the ground. But so do you think that might also play an important role in the supply demand fundamentals?
I talk about it later in this presentation, your point there. Chile year over year is down around 10% in production. And we'll talk about it later on. The main reason for that is geological inflation. The head grades of these copper mines continues to drop decade over decade. And a lot of these very productive mines are near the end of their mine life, and they're now starting to struggle with sources of water because the government is cracking down on these mining companies taking water from local aquifers, and so they're making it mandatory to build desalination plants. It's just getting more tricky to build mines in Chile, and they're much lower grade, requiring much more capital investment. Peru is very precarious right now. If they don't watch it, this could really turn more into Venezuela than perhaps people think. It's definitely not a place for investment right now. And so investment dollars, which are planned for multi-billion-dollar new copper mines over the next few years, is going elsewhere. I would say Argentina and Ecuador could be benefactors in this current decade. But in the long run, I'm going to talk a little bit later on, I think ESG fundamentals will really shine for copper developers, and it may mean places like British Columbia in Canada, where it's primarily hydroelectric power, and you can produce very clean concentrates. Your short distance to travel to Asia may win. This slide is, I thought, one of the best slides of 2020 that I saw anywhere, and this was prepared by Glencore, one of the behemoths in the mining sector, which actually has very strong exposure to gas, coal, and oil. So they know these businesses very, very well. And this shows what is required to get to the climate change goals over the next 30 years. So this is you have a diminishing impact in oil, or a requirement for oil, coal, and gas. And this needs to be replaced by what I said in the last slide, with more metals. And so how much more metals do we need in copper, nickel, cobalt, and zinc? And I'm going to focus on copper here. So what it's saying is that we need to have an extra 30 million tons per annum of copper supply. So that's not per annum. You need 1 million tons per annum additional growth per year. So an extra 30 million tons over the next 30 years. That's the equivalent of one new Escondida per year. We're not building anywhere close to one new Escondida each year. Ivanhoe just built their Kamoa-Kakula mine in DRC, and that is about 500,000 tons of copper production over the next years. Perhaps can get to 1 million tons per annum, but that's just solving for one of these 30 years. So if you think of it that way, it's almost insurmountable to get to these levels that they're talking about by 2050. And if we look at the sheer size, if we had what is 9.2 million tons of nickel on a dollar basis versus 60.1 million tons of copper, copper would be much, much larger than any of these other industries. So where are we within the minerals commodity cycle? So we had a super cycle between, call it 2005 to 2012, 2013. That was really driven by China. There was significant investment in copper mines in this 2010 to 2015 range. And then you got into a period between 2015 to 2020 where there was a lack of investment in the business. And now we've got this disruptive technology or situation that I talked about with climate change. So I certainly think we're in the early innings of another, call it 10-year cycle, could be longer. And we will be I think we'll hit new highs in this illustrative chart as well. One of the reasons why we're not building new copper mines yet, even though we're at the $4 to $4.50 per pound range, is that during this period of time, copper producers were highly levered. Prices were fairly low. They just come off building major mines. And so these copper miners are deleveraging right now, maybe starting to spend a little bit on exploration, focus more on shareholder returns. We're not at the point where they're building new mines. So a great example of that would be First Quantum, who just built Cobre Panama, has $4 or $5 billion of debt in the balance sheet, and is in that deleveraging phase. Others, such like a Capstone, have had projects waiting to get developed for a while and have been looking for the right market conditions to get going. So those projects are starting to move after a hiatus over the last 5+ years, but they're not getting built yet. So Capstone Santo Domingo project is not fully financed. They're working on that right now. There's a large divergence in valuations when you compare producers versus explorers and developers. This is a very interesting dynamic, which ultimately has driven a lack of investment by the juniors in copper exploration. So we haven't seen many new discoveries. And that is because investors playing the large cap producer stocks have been able to make outsized returns on much more liquid names. So I don't see investors moving down the food chain to the juniors just yet. I'll give you an example. 2016 First Quantum was $2.15 Canadian per share, went up to $40 a share in the next few years on massive liquidity. That's trading like a junior, but First Quantum's a $25 billion market cap company. Freeport was similar, Teck was similar. So you've had tremendous volatility in very liquid names to play the base metal sector. You haven't had to go down to the juniors. Right now, if you look at where the producers are trading on a PNAV basis compared to spot price, they're trading about in line, about the same PNAV as where spot is. Whereas the juniors, like an Adventus, are trading an effective $2 to $2.50 a pound copper range. So there's definitely a value proposition there to invest in the juniors, but that money hasn't flowed down to the junior sector yet. Generalist money hasn't flowed into the producers, maybe Freeport being the largest in the sector. But until that generalist money flows in, the conditions won't be right, I think, to start building these new major copper mines that the world needs. I think that starts coming when you see copper breach $5 a pound, going towards $6 or $7 a pound, which I think is very doable over the next year. And M&A, also interesting. It's all interrelated. Several companies have been waiting for the right market conditions to sell, whether they be private equity groups, single asset developers, etc. So they've been waiting since maybe early 2010 to 2013 for the right market conditions. And so there was a bunch of inventory of these type of projects available at the beginning of last year. And most of those have now been sold into the market. Best example would have been Matsa, sold by Trafigura to Sandfire, and KGHMI sold their Sierra Gorda asset to South 32. But another reason why major copper producers haven't been building new mines, because there's been an M&A market for existing producing mines, and another reason why money is not flowing into the junior sector.
Yeah, you can keep going with the presentation. I'm sort of trying to follow up and write down a couple of questions, and then we can target them after a presentation if you want to.
So this sounds good. So this is this geological inflation that I mentioned, which when you combine it with disruptive technologies around climate change, really creates this perfect storm for the copper price. So early 2000s, the average copper mine grade would have been 0.75% copper. Now it is 0.5 and dropping. So Hudbay just put out some news on their Copper World discovery and development project in Arizona. That's 0.35% copper equivalent, and they're advancing that production, for example. SolGold just put out a resource in Ecuador, 0.36% copper equivalent, and they're touting that as an open pit solution for gas gold. So people are talking about projects around 0.35, 0.4. So that's going to mean a lot more capex, a lot more fuel required for projects, a lot more infrastructure, all these things. So with everything going on, these mines are getting more expensive, larger, and more complicated as a result of grade. The last point on this slide is also quite interesting, that the average length of time to take a copper discovery from the discovery phase to production is now over 20 years. It used to be 10 to 15 years. Today, I would say it's more like 20, maybe even 25 years. And that's driven partially because of the social, geopolitical, and government issues that we just talked about, such as in Peru and Chile. Red Chris, for those in North America that are thinking about what's the last copper mine to be built. So Red Chris was built by Imperial Metals. That was discovered in the 60s and took 50 years to develop. So 20 to 25 years might be the average, but there's some that have taken much longer. So a follow-on on geological inflation and my initial point on incentive prices to build new copper mines. So if you look at early 2000s, when that average grade was 0.75%, the C1 cash cost at the time was around $1 a pound, and your capex intensity was about $1.50 per pound produced. Now you fast forward 20 years, so this is official data up to 2015. I don't have it mapped out the last 5 years, but this OPEX, call it early 2022, the C1 cash costs are now in the $2 to $2.50 per pound range. So it's gone up by 200% in just over 20 years. And that incentive price to incentivize that 15% rate of return is now well over $4 a pound, with the average capex intensity close to $10 a pound. And back in 2000, it was shy of $2. So everything is getting way more expensive for lots of reasons. And a big part of it is that geological inflation, energy costs, etc. So this floor here of the $4 plus to incentivize new copper mines is the main reason why I think we're not dropping under $4 a pound. So this slide talks about what I suggested before. You have periods of time where investment is on, where there's a market where the price incentivizes new copper mines. And I talked about that period between 2009 to call it 2013, where it was, as well as prior to the global financial crisis. Forget this dip, because that was somewhat artificial. But 2005 to 2013, you basically had a period of time where the copper price was sufficient to allow for companies to make decisions on building new copper mines. And so you saw a whole whack of them get built, which led to the leveraging up of balance sheets. And then 2014 to last year, you had a period where there wasn't a price that was high enough to incentivize new copper mines. So inventory levels went up, and then we started chewing through those inventory levels. And now you've got this climate change disruption path. And you've seen last year a period for reinvestment, but you entered then this year, and that red or that orange line would have dropped below the copper price. And now we're in kind of an equilibrium between copper price and incentive price required. That's why I think going forward, you're going to see copper be much, much higher. It's going to be similar to 2006, where the copper price shot up like 3 to 4 times. And so therefore, new mines got built. So I think similarly, you could see the copper price go, as I mentioned, to $10 a pound to be in this incentivization period to be able to build new copper mines. So all this results in some final comments from my perspective on some of these are more thought pieces. If you think about the world's largest 5 non-fossil fuel commodities, I mean oil when I say that, oil and natural gas. In order, it goes iron ore, coal, copper, gold, and potash. And so these major mining companies, but also oil and gas companies, need to think about that when they want to maybe diversify the revenues. And if I think about what's the most important sector or metal to be growing in, as I mentioned previously, is going to be copper. So all the major mining companies are focused on that. And I make a comment here, you may see oil and gas companies re-enter the mining business. Oil and gas companies are generating a ton of profits right now. They're focused on giving it back to investors. I would argue it may be a good time to start thinking a little bit further into the future and seeing how they transition their business. I'm not saying oil and gas are going to go anywhere anytime soon, but I do think over the next 30 years, some of these businesses, oil and gas business, may go back to the mining sector like they were in the 60s or 70s. Investors may be looking for assets that preserve value. So there isn't a better metal, in my opinion, to be investing in to preserve value, but also have that significant upside down the road. So I think copper could replace some gold holdings, might substitute cryptocurrencies. But if I'm a gold producer, and gold, you can argue, may have less reasons to be relevant in the world going forward, I would be focused on gold copper deposits. Exactly what Pierre Lassonde is saying and what Mark Bristow is saying. If you can find a good copper gold deposit, it's a license to make money, and it also allows these companies to transition into this copper super cycle that I'm talking about. Glencore and Trafigura are the largest metals traders in the world. Clearly, Glencore knows all these commodities from the slide earlier on. Their CEOs have said that this was commentary last year, that the copper price has to be 50% higher for longer to incentivize new development of copper mines, to allow for that $100 billion plus of investment required to build those mines, to satisfy the gap. And last week, Goldman Sachs, this was a Bloomberg article, said that they're not calling for this, but they think it's reasonable to see copper go as high as $50,000 to $100,000 per ton in a serious supply-demand shock scenario. What is $100,000 a ton? We're talking about $45 a pound. Currently, that's 10 times where we are today. I think that sounds crazy, but I think that if we want to be serious to getting to our goals in 2050, we might have to get lithium prices may be a good example of what can happen to the copper price. So Glencore, Trafigura, Goldman Sachs, these are all smart groups. They don't want to look stupid, but when you start talking like that, I think people should pay attention. As I mentioned earlier, we're one pit wall failure away, or an earthquake in a major copper mining region, from wiping out the inventories. We're talking about social unrest, so Chile and Peru may be more difficult to develop mines in the short term, but also these countries. Let's talk about DRC, Zambia, Chile, and Peru. All of those, whenever the copper price is strong, try to go back and extract additional capital from mining companies. And so that's another reason why the incentive price for copper might go higher if you add those subsidies basically to the mines. And as I mentioned previously, I don't think people should focus on current supply demand. The ask is so steep in such a short order that we need to be making the investments now. Otherwise, it's just going to exacerbate what's going to happen in the future, and this 50 to 100,000 dollars per ton copper may actually come to fruition. And this last point I mentioned, while I don't think this is a short-term risk, I do think over the long term, there may be some kind of blockchain kind of scheme with metals where people want to know where the metals are coming from and they want to have ESG or green metals. So they don't want to have copper coming from a mine that's powered by a coal-fired power plant, which is, for example, what Cobre Panama, First Quantum's Cobre Panama in Panama is being powered on. So if I think about a jurisdiction that can win more than any in that ESG copper would be British Columbia in Canada. Hence another reason why I've got the surge story. Some thoughts for you, Antonio?
Yeah. That was a very good overview. Would you, just before we get into the some of the questions that I want to do, do you think that copper is sort of the best metal to play the green revolution? Like, is it better than cobalt, lithium, and all the other ones?
Absolutely. This goes back to this slide. It's the largest commodity out of these four. It doesn't have lithium on here, but by largest commodity, it means it's the most transparent. And it's the commodity that is likely going to have the most M&A and the majors needed the most. So everything aligns in terms of a strong ecosystem for the space and investment. I'm not saying you can't make money in these other ones, but I like those factors around copper. Another thing with copper is it touches every point in electrification. So it starts with power plant, then delivering the power to the source, then it's charging stations, then it's your vehicle or iterations of that. Whereas some of these other commodities are more focused on the actual battery and not the whole life cycle. And a big part of it is the electrification or the upgrade of electrification in the grid. And that's going to have an outsized requirement for copper.
Okay, fair enough. I whenever I hear some of the predictions of people that are like, you know, a little bit out there, like when people start talking about $600 silver or $10,000 gold and all these things, I start looking for, okay, well, what is maybe something that they're not telling us, or what are some of the bear theses? And that's something that I also wanted to talk to you about. One of the questions that I wrote down as you were presenting was, okay, you mentioned China's upside, but what about China's potential downside to the copper story? Like, can China, because they're doing sort of the opposite of what the US is doing. You know, they're not pushing interest rates up. They're actually dropping interest rates down. They're stimulating more investments because they've a couple of times they've expressed the desire to sort of suppress commodity prices so that they can have cheaper growth. So where you have environmental challenges and all these other challenges that other countries are having, couldn't China actually make a push and make all that happen much faster and sort of swamp the market with a bunch of copper supply? Like, is that even possible?
You just brought up another key point. It's helpful to be invested in commodities that China doesn't have. China doesn't have much copper. So that's another point. So no, China can't swamp the market with copper, which is one of the risks to some of the more minor metals like zinc that Glencore shows here. China produces 50% of the world's zinc. So they have controlled the zinc market to a certain extent over the years. So you don't have that risk with regards to China swamping the market. If none of this comes to fruition and we just flatline copper production as is right now, you're still going to have a very strong case for investment in copper just to keep levels as is, which is another point. But I really think that the train's left the station on climate change. I don't think we will get to this net zero emissions target by 2050. But even if we get halfway there, the metals requirement to get there may be insurmountable. Copper also, while there is a recycling business to it, most of it stays in the ground or stays in use on a percentage of primary supply. So that's another thing going for it. And from a substitution perspective, aluminum currently, for some applications, depending on the price difference between aluminum and copper, has been substituted in the past. Aluminum fundamentals are very strong right now. Inventories are getting chewed up at a record pace. Aluminum prices have risen significantly. I think aluminum may have a problem from an ESG perspective because it is so energy intensive, and a lot of the aluminum production in the world is currently powered by coal-fired power. So I don't think aluminum is at a risk to replacing copper in a short term or medium or long term. And there's nothing else that can really do the trick as copper.
Okay, fair enough. I like personally, I'm more attractive to stories that have their bullish fundamentals coming from the supply side, rather than the demand side, if that makes any sense. Because the demand, a lot of things can happen. Like, I'm not saying there's a high probability for it, but we can wake up tomorrow and realize that electric vehicles are actually not that good of a solution or whatever, and we stop needing copper. But once you start having production challenges, there's going to be a baseline of copper that we're always going to be needing for some type of construction. If you have production challenges and they cannot meet that, then it's sort of becoming, the uranium story too, which is also what attracted me to it. So that's what I'm trying to test. I'm sort of trying to test the supply side of the whole story. And another thing would be, you mentioned grades. I think that was one of your slides. Sure, grades are generally getting lower, and that's true. But what about new extraction technologies that will, allegedly make copper, will extracting copper, they make it cheaper, safer, quicker, more environmentally friendly, and all that, and therefore make it easier to permit and so on? Is that not a viable bear thesis where new technology?
So new technologies in the mining sector are slow to come by. They're slow to adopt because generally these mines are so difficult, so expensive to build, and you go for the sure thing. If you rely on a new technology and for some reason it doesn't work, then the whole thing blows up. There's only one new technology right now that has a chance to make a dent in the market, but it's really not going to save what I think is inevitable. And this is this jetty technologies out of, I believe it's out of Arizona. It allows companies to leach copper from chalcopyrite in heap leaches,
right?
Which was never possible before. A lot of the major companies in the world are now piloting this on their brownfields projects where they got these heaps of chalcopyrite, and it seems to be working reasonably well. This has the chance to add a few 100,000 tons of copper production in the market by the end of this decade. But in no way or form is it going to result in a new Escondida a year for 30 years. This is it's like building a new Kamoa-Kakula over the next 30 years, and that's about it. So outside of that, I don't see any technologies that are going to be a step change in the business.
Yeah, that's exactly. I didn't want to mention any names. I didn't know how comfortable you feel that, but that's the exact technology that I was referring to. Because I don't even think there's anything really viable out there besides what you mentioned.
And that technology only works in arid locations, so desert to semi-desert. So it's great for Arizona. It can work in Chile, but it's not going to work in Peru or Papua New Guinea or British Columbia, etc. So it has a limited number of opportunities.
Mm-hmm. Okay. The sort of the next thing that, like, for example, you don't have with silver is recycling. Like, for example, in the silver story, recycling is rather tough on silver just because there's the small components or whatever. I don't really know. But so I just know that it's tough. Copper recycling, on the other hand, not as tough. I've even seen, I come from Bulgaria. People would light these huge fires and they would sort of melt the rubber thing on an electrical wire or whatever, a line, and they would just take the copper out and sort of recycle it, sell it to a recycling point. How's recycling in the copper market? Does that happen a lot?
Yeah, recycling does happen in the copper market, but as I mentioned earlier, it's not a major part of it. When would you recycle copper? You would recycle copper if you're demolishing a house or an apartment block. So that's happening all the time, but more new buildings are getting built than ones getting demolished, to make it simple. So it is a lower percentage of recycling in copper, as I mentioned, as a basis of the primary production than other metals.
Right. What I was thinking, this might be a very silly point on my end, but what I was thinking is that if copper is going to these prices that you mentioned, that those traders or whatever mentioned, is that 10x from here, you've got so much copper in an electric vehicle. Sometimes it might have made sense to sort of put a new battery or put new whatever in the electric vehicle, but wouldn't on some occasions make sense to just recycle the vehicle instead of bring it back to life? And therefore, am I making any sense? I don't know.
Yeah, that makes sense, and that's going to be a function. And I'm not sure how that plays in the demand projections, but it is driven by the life cycle of a battery. My understanding today, there are 10 years for electric vehicles. When technology gets better, those batteries are going to last longer. So definitely there's going to be a recycling aspect to that, but the world is going to go from fossil fuels to battery vehicles, and that switch is in the billions of vehicles when it's all said and done. That's going to take a lot of metal to get going. Once everybody is transferred over, there's going to be a huge recycling business involved in recycling these batteries. And I know certain companies are starting up factories, to do that, to recover all the metals from the batteries. But we're just in the infancy of the whole revolution right now.
What then is sort of the? I guess maybe you can talk to me about what does the world really look like when copper starts going over $10? Like, does much change? Because they call it Dr. Copper, but if copper is really, really expensive, 2 to 3 times today's price, what does the world look like? Are we able to build? Does it make sense, or does it cause damage? Does it bring us into a recession? What do you think?
That's a really good question. I think at some point, ultimately what it means is the prices for the metals are going to get so high that some of the pledges of the governments to be all electric by a certain year, and remove fossil fuels from the road, or get to a certain climate change goal, we'll have to change those benchmarks. It's just not going to be possible unless the government starts subsidizing battery packs, as an example, or prioritizing the construction of mines, streamlining the whole permitting process. The educational piece, the mining in general is seen as very negative. In Canada, we've embraced it. In most countries, there's an educational piece required. In the case of the United States, it's, we want electric vehicles and climate change, all this, but we won't permit a copper mine in my backyard. That's going to have to change. U.S. has very good copper deposits that are just sitting there stuck in permitting. So I think it's going to be a prioritization of mining, or we're not going to achieve these goals.
That does make sense. I was mostly looking for sort of a number, because Rick Rowe would always tell me one of his favorite lines would be, the cure for high prices is high prices. And that would also sort of help me calculate the risk reward, because if you're telling me the risk is to fall to $4, which you call the new normal, the new sort of new bottom, what is the reward? Like, what is the cure for the high prices in copper? Is it 10, 45, whatever you think it is?
I personally don't know how high it's going to go. I just know it's going higher. And when you have I've used the word disruptive again, a disruptive situation that is completely overturning what we've known over the last 100 years with fossil fuel vehicles. Not sure where this takes us. It's a daunting task. I think we can all agree that copper is going to be a winner, though.
Okay, yeah, that's makes me think about the reward part on it and how you might want to approach that. Is it? Oh, if $4 copper is the new normal, is it also fair? And if we're going into this type of economy, I've also seen some of the whatever videos or articles that analysts would say that copper is the new oil. Are there any similarities? Because if I remember watching a movie, I believe it was on John Getty or whatever. No, was it? I don't remember. Like he became very rich from bringing in oil from Qatar or somewhere around those places, and that just reminded me of that whole time period that the really, really rich, wealthy people really were, in the multi-billionaires were created because of the oil boom. And is copper bringing up some similarities in your eyes?
Yes, I think so. The new Saudi Arabia of the climate change revolution could be Chile if they want to embrace it. But it could be Argentina, it could be Ecuador, Peru, DRC is going to do well. This is going to create generational wealth and kind of vault these countries to really have countries. So yeah, I think it has direct analogies. You go back to, we need one new Escondida a year for 30 years. Just think what that could be in terms of investment and exploration, new development, tax dollars, all these kind of things. We're talking about hundreds of billions of dollars that are on the line, and there's enough to share with everyone. And it'll be a lot of new mining entrepreneurs that make a lot of money off of this as well.
Nice. That's, you're making me want to buy real estate in these places, because if I remember what happened to the real estate of all the Saudi Arabia places was an interesting play too. Much easier to be buying stocks from the comfort of my couch, of course. Let's maybe talk about that. You mentioned, to the companies that you're involved in. It's interesting to me why the stocks are sort of lagging the price. Price of one of the companies that you're sitting on, and again, for disclaimer, honest confession, I'm invested in that company, Surge Copper, but its price has dropped almost 50% in the last 52 weeks. Well, the price of copper is rather flat. It's down about 1% or so, but let's call it flat. And so that caught my attention. That company loses half of its market cap. Copper is not down at all. And even over the short term, the last month, Surge, for example, again, has lost over 16% of its market cap, while copper is up about 6% on the monthly. So what's happening? Why is there a disconnect between these things? And also the stocks are much cheaper today, most of the copper stocks, than they were when copper was at the same price last year, basically. So why is that?
Yeah, so that goes back to my point on this funny market we're in, and this general deleveraging that's occurred globally. And I thought we might have been somewhat insulated in the commodity sector, but that clearly wasn't the case if you look at share prices between middle of April to middle of May. My gauge of the health of the mining sector as a whole, and when I say a whole, and I talk about ecosystem, it means also the junior end of the market. Because the juniors typically lead the discoveries. You need money to do exploration. That's higher risk. And when you have that money flowing in the junior space, then you typically have a healthy ecosystem, and you have generalist money coming into the space as a whole. So the venture exchange dropped 25% over 3 weeks. So kind of April 19th to call it May 10th or so. That's despite, as you said, commodity prices being near record highs and inventories being low, if we talk about copper. So what happened during that period of time, does not reflect the fundamentals of the copper space. It reflects the deleveraging, margin calls, etc., that's happened around the world. So to me, the buying opportunity is phenomenal, especially in copper. But it goes back to this slide here, where we talk about the fundamentals in the market and why we haven't seen much investment in the junior space. The investors that are in the base metal space have continued to focus on the producers. Look at a Copper Mountain, for example. It's gone from, say, beginning of April was probably around $3.50 a share, went down to $2 a share during that period I talked about, under very good liquidity, generating good free cash. So why invest in the juniors? And now it's hit $2 and it's back to around $2.80 or $2.90 a share. Why invest in the juniors? So it will come in the junior space, but we need to have investors move down market, and we need to see generalists start to come on the higher end of the spectrum, valuing these producers at call 1 times PNAV based on spot, and then the value investor will move down to the junior sector. So it's a combination of very interesting market fundamentals as a whole over the last 2 months, and just the where we are in the cycle and the type of investor that's lacking in the junior sector.
What do you think is, because you mentioned them in tranches, I like doing that as well. I'm not doing it with my own money, but I like theorizing it. I'm not doing it with my own money because I feel like I need to be aggressive right now. I just have that gut feeling, but I don't really know what I'm doing. But so I like theoretically theorizing it in tranches. What do you think is the best way to play this thesis from a risk reward perspective? Theoretically, do I diversify between producers, developers, and explorers, and also maybe towards, because you're saying we're early innings, so maybe during the early innings, I'm heavier on the companies that people do want to own, companies that are cash flowing. I have a little bit of exposure to developers, very low exposure to explorers, and then towards the later innings, when explorers start attracting more eyeballs, I sort of rotate that capital the other way around, explorer heavy, almost no producers because they've already had the upside that they had, and developers only the good ones. Is that how would you approach it?
Depends on what kind of investor you are. If you're looking for returns over the next 6 to 12 months, in the 25 to 50% range, then I think you can stick with the producers like a Copper Mountain. If you're looking for multiples return over 2 to 5 year period, then I think the value proposition in the juniors is where it would be. And to our last interview, I would be focusing on those juniors that have very strong financial backers, ability to weather the storm and continue to de-lever, advancing their projects. So put my money where my mouth is. I'm betting on the junior side of things, and that going well over the next few years.
I was kind of hoping that you would break my biases and help me see through it, because I feel like I'm being very aggressive, and some people would tell me I'm being too aggressive for no reason. But that's what I feel like I'm supposed to be doing. And yeah, nice plug to our previous conversation, because if you want to, if somebody's watching, I'm revisiting that conversation myself. Somebody's watching, they want to know how to pick the right juniors. There's definitely a bunch of wrong juniors out there. There's a conversation that we did last time, was about an hour and a half or something, going over what are the good, the bad, and the ugly things that happen in the industry. Did you feel comfortable talking about other companies, Christian, that besides the ones that you're involved in, or would you prefer not to mention any names?
Sure. I hate bashing specific names in the business, but hopefully they're all good ones that you mentioned.
I get. First of all, nobody should. I'm just letting you know this just to get your opinion on it, but nobody should care about what stocks I own. I own only 2 stocks, but again, I have no idea what I'm doing. I own Surge. Now, obviously, you that one you mentioned. I also own QC, Copper, and Gold. Because of the combination of the team, I know the team myself, and that's also what I liked there. Have you heard of them?
Yeah, they're the group in Quebec that is developing a former underground copper mine into an open pit. Is that correct?
I would guess that's pretty well put. Yeah.
Yeah. I don't know it that well, but I would be keen to look at the resource on it, how it was calculated, who did it, the assumptions behind it. Does it actually hang together under the concept of an open pit or not? So that's all I can comment on that one.
Okay, it's an interesting story though, and it sort of go big or go home the way that I understood.
Yeah, definitely, that concept has worked reasonably well in the gold space. Like, look at Canadian Malartic, which was a Cisco now, Agnico and Yamana. Same thing as Detour Gold. Those were large underground mines that were rescoped as lower grade, massive open pit mines. So that has been a trend in the gold space. I'm not sure that's the market these days. Those companies were built in this super cycle, really funded right here where my cursor is. That was at the end of a super cycle where there was not unlimited, but almost unlimited capital in the market to support something like that. We're not in that kind of market right now. So, there's certain gold companies that are trying to do that. I think they're going to struggle raising capital to do so. Can that market be there to support that kind of model in the copper space? Well, clearly, if we think copper is going to $10, yes. But you really need to look at the technical merits of that strategy on that specific project.
Yeah. Are there any that you maybe wanted to get in, but you haven't managed yet? Like the price maybe got away on you, or something else that you like, but you like it at lower price out there?
Well, if we talk about what are the most successful copper companies over the last few years that are in the non-producer side of things, clearly Filo Mining, Solaris, and SolGold have done very, very well. All three are world-class discoveries. And if you got into Solaris in the $2-3 range, or Filo last year after discovery around $6-7, we've done very well. We're in a market right now where investors believe those projects are very strategic, world-class, as I mentioned, and there's going to be M&A coming soon. And so I think that's the view that these companies will be acquired over the next few years. I would love to see NPV calculations on kind of time value, adding time value money, the cost to take it through all the studies, et cetera, and where they trade on a PNAV basis. But those are huge wins that I think are awesome achievements. At these levels, I don't think it would be a buyer. I don't buy just for the potential of M&A. In terms of other names, I really believe in future British Columbia copper, really from an ESG perspective. So there's a few that I've been involved in or invested in the BC exploration space. In terms of producers, I think there's some awesome companies out there. I would say First Quantum is probably the most impressive story that I've seen in my career in the mining business, starting with a handful of small copper mines over 20 years ago, and using that free cash flow to go eventually larger now with three super mines globally, and one of the top producers globally. That's super impressive. So First Quantum has been a staple, off and on over the years. Certainly was when it was sub $10 a pound. Lundin Mining even though they've had some hiccups, has been an awesome producer and has great operating company over the last 10 years. I've been in and out of that one. Teck Resources is another one. I got to mention the larger producer size that is got some terrific assets and is pivoting the company into copper. And on the junior side, I would say Copper Mountain would be the one that is the cheapest and the most interesting to me. I would say it would be quite positive that they can sell their Australian development asset, remove that development risk in a completely different jurisdiction, and really focus on their mine in British Columbia, which I think if they're able to take the production up to 100,000 tons per day for call it a 40-year mine life, to me that's a tier one copper mine and should be of interest to any acquirer.
Thanks for going all these names, and it's I appreciate that. I've looked into, I guess, most of them. I never pulled the trigger again. It's sort of my strategy to it. How do you plan on making money on all these plays? Like, what is your exiting strategy? Would you start selling out in tranches once the copper price hits certain level, or how would you approach that?
Well, I mentioned the majority of my portfolio is in Surge and Adventus. So, I mean, those are longer term holds. In the case of Adventus, I see us building El Domo and generating 100 million US plus of free cash flow and building, trying to replicate maybe what Lundin Mining did or First Quantum over the next 20 years. I mean, that's what El Domo can do. In the case of Surge, I believe we're on the cusp of a few major new discoveries this year, solidifying that district as a multi-billion ton porphyry district. And then it's going to be a decision of is it strategic enough for Rio Tinto or so to buy it, or are we going to develop it on our own, potentially with the infrastructure that's right in the district. So I see that more of a M&A strategic story for bigger guys. In terms of the producers, I just watch and brokers do this kind of analysis fairly regularly. I'd watch where these producers are trading on a PNAV multiple compared to the spot price. And when you see opportunities for discounts, then I would jump into the market. So Copper Mountain, as an example, when it went from $3.50 a share down to $2, buying in a $2 to $2.30 range is a no-brainer. But I see those as more short-term trades. Arrow Copper would be another cheap one on the more junior side, which sold off from $20 down to $13, and I would have been buying that in the kind of $13 to $15 range for a pretty quick return.
So in 20 years, I guess that's a reasonable way to look at it, because I had a question on here, and that would be how does a CEO or a board member, how do you exit, how do you actually make money without crashing the whole story? Because if somebody's relying on you to being invested in the story, holding that many shares, how do you exit without crashing the story beneath you, I guess? So how would you exit Surge? Like if it gets bought out, you just get paid based on the shares that you own, and but you wouldn't sell before that. Even if copper goes to $10 like in the next 2 months, you still wouldn't sell. Is that it?
Well, I have my buckets of core holdings where I'm an insider and I'm developing real businesses. Those are long-term holds. So like you said, even if copper goes to $10, it wouldn't be a seller. Then you have the other bucket of investments out there where I keep track of, call it half a dozen copper companies, and I pick my spots to enter and exit based on relative value cycles, those kind of things. It's important for companies like junior companies, like look at Adventus and Surge, to have as much optionality as possible. That's what I look for in junior plays, so that there isn't only one outcome that will determine success. There are multiple avenues to create value, and you can pivot depending on the market, availability of capital, So in the case of Adventus, we're on our way to building our first copper mine and generating free cash. We're financed to do so, but we also have significant porphyry exploration assets that are big potential size, and we can modify the budget on exploration spending there depending on the market. In the case of Surge, we've got now 20 geophysical targets to go after through, as I said, significantly grow the resource base to make it a world-class porphyry district. But then we also have options to get in production fairly quickly as well. And we're also in a great location that could be of interest to several majors. So I think it comes down to optionality, understanding the levers that you can pull on that optionality, and making the right decisions as a board, dependent on where you are in the market.
Fair enough. I like that answer. What else about copper? I'm looking through some of my notes. I think we targeted. I think this was a very comprehensive overview of where copper is, where it's going, what could happen, what might not happen, and even some of the place. What am I forgetting to ask?
Now you put me in the spot. I think we've talked about most of the aspects that are relevant. I feel like for some reason, even though copper is critical to everything in to do with battery metals and climate change, investors, in particular more speculative investors, have just forgotten about copper and skipped right into lithium, for example, or cobalt or graphite, and they're skipping over the most critical metal of them all. So hopefully some of your listeners take away that copper is going to be integral part of all of this, no matter what happens. Some of those other metals are important, but maybe more focused on the battery side of things. Technologies can change on the battery side of things, and see that as much more speculative with significant downside. I wouldn't be doing a presentation on a new normal for the lithium price, for example, but I'm very confident to be saying it about the copper price.
Now you're constantly, maybe I have said that many times, but I think I might be a Rick Roll fanboy. But now you're bringing something up that he told me, is that you should be looking for when stories, not if stories. And it sounds to me like a lot of the other metals are sort of if stories, based on what you're saying. And copper is definitely a when story. And the when in a certain way is now, because some of these companies are cash flowing right now. But going forward, there's also a lot of upside potential. So there's one thing in being cheap, and there's another thing in having upside potential. There's a lot of metals out there that are cheap, but they're never coming out of the ground because we don't really need them. There's no real supply issues and stuff like that. And then you have copper, who's actually ticking all these boxes. That's sort of what I'm taking away here. Does that make sense?
Yeah, I don't want to take away from the importance of the other metals, but if you want to dumb it down, I think you said it right.
Okay. Yeah, dumb it down. That's how I like it. So yeah, Christian, thank you for investing your time with me, sir. This was great. Yeah, had a lot of value.
Thank you, Antonio. I had fun too. Hopefully, we'll get some new investors in the copper space.
Well, we'll see, and I'm also willing to do. I hope you are to do follow-up interviews if there's any questions, stuff that we missed or whatever. Comments are always open. The email is always open. I think you're like on Twitter. You can reach out to me. You can reach out to you. I think so. Yeah.
Yeah, I'm very easily accessible. Christian@ventusmining.com or on Twitter. My handle is @ventusceo.
Yep, absolutely. I can attest to that because that's how I reached out to you. And sometimes people would say, thank you for doing this, and I'm like, honestly, I'm not really doing much. I'm sending a message to somebody on Twitter. Most of the guys that I talk to are just great people, and they would answer my emails and my Twitter DMs or whatever, even though I'm irrelevant. And so, yeah, that's what you said. I can attest that. Yeah, thanks for being here, man.
Cheers.